something happened in 2019. Okay, now anybody knows what happened in 2019? Okay, SMG member, you know the answer already, so don't spoil it for them, okay? Right? But for the rest of you, anybody knows what is the financial horror that happened in 2019? I give you the date so that you can know it better. September 2019. It's literally months before we have the COVID. We have the COVID in somewhere around February, March, right? In 2020. Kelvin said the Conjuring. Conjuring what? Okay, so let me share with you all what happened in 2019. Okay, and I want to bring to today and share with you why, to me, right, this is a real horror, a real scare. Okay, it's the financial plumbing situation. Now, what is financial plumbing? Okay, is this thing called the repo? Do you guys know what is repo? Anybody knows what is repo? Can you type in the chat? Type yes in the chat. If you don't know what is repo, just type no. I just want to see what's your understanding, then I can calibrate my sharing with you guys. Okay, so May say no, Lin no, Andy no, Heng is yes. Wow, so many no. Wow, okay. This is super important. Okay, so good that y'all are here. Good that y'all are understanding this. Okay, so repo is basically a short name, right, for what we know as the repurchase agreement market. Okay. And this is known as the financial plumbing of the market because it is basically two parties, usually a bank and another institution, borrowing money from one another, right? Very, very short term for overnight. And this is collateralized by treasuries. Okay. So I give you an example. I give you an example using illustration. So let's say financial institution A, FIA, okay, says that, hey, I need $100 million very urgently overnight. Maybe because I need to fulfill a purchase, okay? But I don't want to sell away my assets yet, okay? Because they have assets. Usually bank holds a lot of bonds. So instead of incurring all the costs of selling the bonds and then later take the money, go and fulfill the purchase, then later on you have to buy the bond back, right? They say, okay, my cash flow only come tomorrow, but now I need the money. So what can I do? They will go to another financial institution, FIB, right? Bank B, okay, that says Bank B, to say, hey, can you lend me 100 million or not? But to make you feel safe, what I will do is I will give you my 100 million worth in bonds temporarily. Okay, so let's say this is the Bank B, so Bank B will say, yes, I will lend it to you. Then I say, oh, thank you very much. Okay, so but what's the benefit for Bank B? To just lend me 100 million and don't get anything, meh? Cannot be. Okay? So what happens is the next day, Bank B will say, hey, Bank A, I will return you 100 million in bonds already. But you must pay me the overnight interest. So I'm the Bank A, right? I say, okay, I will pay you what we know as the repo rate. Okay? Now, this repo rate usually is very low because it's only one night. So imagine the lending rate, right, is 2% per annum divide by 365. Right? So the actual rate you get is 0.00 something. It's very low one. Okay? Okay, like what Katie said, sounds like a bridging loan. Yes, it is a bridging loan. Okay? So who needs repo? Who needs this bridging loan? It's basically anyone who needs the cash urgently, but they just don't want to sell their assets now because the cash flow is coming tomorrow, right? For example, insurance company who suddenly need to pay out massively, maybe there's a disaster, there's a hurricane or something, okay? Or hedge funds who say, hey, we need the money to kind of like, address some margin call issue, liquidity issue now, but my money will come tomorrow. But I need the money now. How? They will go and borrow, okay? Investment bank does that as well, or even corporate companies. Now, recently, as you can see just now, the rates, okay, usually is very calm one. Okay. Usually is like no, not too scary. But in 2019, okay, in September 2019, you can see this. Suddenly overnight, right? The repo rates from 2% jump all the way up to above 5%. Overnight, jump 3%, Okay. So it shot up like crazy. Why? Because at that moment, many parties needed money for different reasons, right? And the banks that has a lot of cash at that moment were doing what we call de-risking. They were stockpiling all this cash and they say, hey, to lend out this cash, I feel very unsafe. To lend out, I would need to be paid more. So they keep on restricting the liquidity. In short, what is happening is that the financial system, think of it as a pipe that has a lot of water flowing, right? Then the water is cash. Okay. And for that moment, right, suddenly there was not enough cash in the system. Now, when the demand is high and the supply is low, what do we see? We see that the repo rates, or they call it the SOFR rates, secured overnight financing rate, SOFR, okay, shot up to 5%. So in 2019, wow, Obama super stressed, okay, right? Because was it Obama? Is it Biden already, right? Okay, so the SOFR rate jumped from 2% to 5.25%. In fact, some trades were reportedly cleared at a 10%. And think about it, this is not the bank asking another bank to lend me money without any collateral, It is way more secure than mortgage loan, because they literally give them what we call a high quality asset known as the US Treasury. And yet, people cannot get the funding. Can you imagine? It's like you go to the bank, right? You give them bonds, government bonds, and you say, I want to borrow money based on government bonds, and they tell you go and fly kite. Okay. So the rates came out so high, it was crazy. Now, why did this happen? Because usually when the people cannot find money in the system, right, what do? If the hedge fund or the banks, they try to borrow from the broad market, the public market, and there was no money, who can they turn to? Right? Who can they turn to? If there's no financial institute B, who can they turn to? They will turn to Along, no Along. Okay. Who is the legal Along in the US? Who is the legal loan shark? Not loan shark, okay? It's Jerome Powell. It's the Federal Reserve, right? So the Federal Reserve can actually lend them money, but this is the horror story. The horror story is that when the banks go to Federal Reserve was like, sorry, man, I also cannot lend you too much. Why? Because I don't have enough money myself. So at that point in time, in 2018 starting, right, actually the Federal Reserve was already reducing their balance sheet rate. So at the same time, they are also draining cash out of the system. Okay? Out of the system. They basically wanted to, sell away the bonds that they have bought too much. So when they sell, they receive cash, right? They are draining money out of the system. Okay? So what happened in the end is that the Federal Reserve step in, and overnight they say, don't worry, everybody, I'm going to lend to all of you. Whoever needs money, I lend. Okay? They offered $75 billion, which of that, 53 billion were taken up by the banks. Overnight. Right? How to overnight come up with 75 billion? I let you go and think about it. And in the end, they started this whole thing called the standing facility, the repo standing facility. Right? RSF, where they say, next time if this happen again, I will lend all of you money. But by doing that, what happened is that they effectively ended their QT, which is just now what I mentioned, reducing the balance sheet. They stopped doing this because if they do this, there will be no more money in the system. Does it sound very familiar? Right? Because in 2019, it was the first intervention since 2008, the global financial crisis. And right now, what just happened? Did something happen recently as well? Why did do you ask the question? Why did Jerome Powell recently say, "Hey, we are going to stop quantitative tightening. We are not going to reduce our balance sheet. We're going to stop first. We're not going to reduce further." Why? For the longest time, they have been trying to reduce their balance sheet, But why did they stop? It's because recently, once again, in the September-October period, we start to see the repo market having such a problem again. The plumbing is not working. The toilet bowl is choked. It is going to flood, and all the manure is going to flow out of the toilet bowl and make everybody stinky. Okay? So in mid-September, it was the first sign. One night, the standing repo facility was tapped for 18.5 billion. That means the bankers or whoever needed it, right, went out to the market and there was no money that they can borrow. So they went to the Federal Reserve. And at the same time, the SOFR rate from 2 plus percent jumped all the way to 4.42%. Okay? In fact, not just September, as we are all quietly investing, stock market all-time high, the horror story started. This was October this year. Just happened a few weeks ago. In fact, this was the highest spread between what they call the overall rates and the interest of the reserve, okay, since COVID. So we are seeing the same stress as what took place again. Although this one is super high, okay, this is crazy. But this is once again the highest since COVID. Okay. In fact, some of the observers on Twitter, on X, they actually mentioned, right? The SOFR rate came in, it was 2%, 2 basis point above the discount window. Wow. Okay, and it got tapped another 7.7 billion. This was just 2 days ago, 3 days ago. The overall Fed fund rate that is being determined not by Jerome Powell, by the banks themselves, went up to 4.12%. Okay? It is the first time that we saw the standing repo facility after being created was tapped so many times in just 1 month. Last time, long time ago, it's like once in a blue moon, they need to go to Federal Reserve to ask for money. Once in a blue moon, they go to Federal Reserve. But the last month of September, October is like almost every week. The banks have to go and beg Jerome Powell to give them money because the system was running out of cash. The plumbing ceased. Now, if you still don't understand how severe this could be, the 2008 global financial crisis was basically a mirror image of this, but at a smaller level because the liquidity crunch was only on one bank called Lehman Brothers, right? But this time, this one is more than Lehman Brothers. The only thing that the Federal Reserve never tell us is which are these banks. And Lisi is saying private credit. No, this is not private credit. Not just private credit. Because private credit is not such a big market. This is institutional credit, public credit. Okay? In fact, when Jerome Powell dropped the interest rate, right, in September, boom, like that, right? The public lending basically is saying we cannot lend at this rate. The banks don't feel safe. So effectively wiping away the Fed cuts, the rate cut dropped to here, right? But can you see the blue line, which is the actual lending rate, the actual SOFR rate, right? Went back to where it was before the rate cut. So Jerome Powell is trying very hard to pull it down, but the borrowing cost went back up again. Okay? So right now, then today, right, at the radio station, when the DJ asked me, hey, Pete, how do you feel about Federal Reserve starting the QT? And very politely, I said, yeah, QT is good lah, everything, okay? But here is where I want to tell you all a bit more about how I feel. Is that there is a difference between the Federal Reserve proactively stopping the tightening, right, to save the market versus something already broke. Then they have no choice but to save the market. Right? So this is proactively trying to prevent something from happening. Option A. Option B is something already broke. Something is broken. And they are trying to save the situation. Now, what do you think it is? Okay? Type in the chat. What do you think it is? My personal belief, I think it's always a spectrum. But I believe we are closer to B than to A. Okay? Because Jerome Powell could have just cut rate and not mentioned the QT one. But the fact that he mentioned that right after all the repo facilities started getting tapped, right, is a very telling sign. But fortunately, the good thing is that nothing is broken. Nothing is broken. Everything is good. Hunky dory, jolly shandy. Right? Everything is good. But think about what if it really happens now? Can the history repeat itself again? Because we are seeing very similar situation as what took place in 2019 and also in 2008. Fed was trying to reduce balance sheet. They have bought so much debt leading up to it, right? Okay, just like after COVID, they bought so much, they're trying to reduce it. Just like now. Okay? And the borrowing cost is increasing, signaling that, hey, the liquidity, the funding is very stressed. No, nobody want to lend money. The bank will only lend money if they are paid crazy amount of interest, right? And the recent balance sheet reduction has dropped the bank reserve, okay, all the way down to less than 3 trillion. That means there's a reason why the bank don't want to lend money because they scared that what if I'm the one that needs money? It's like, you have a lot of water, right? And you're trying to flush the plumbing, right? Then you're like, hey, wait. What if I also need to flush my own plumbing? Self-preservation. Okay? Self-preservation. So right now, I would say the Federal Reserve is very stuck. Why? Because if they cut very aggressively, what's going to happen? Okay, so all of you here are invest with Pete, and some of you are even my SMG members. So let's do some training. What if Federal Reserve cut very aggressively? What's going to happen? What's going to boom? What's going to explode? Type in the chat, okay? Let me drink some water. Cut aggressively, market will crash. No, Weilun, no, market won't crash. Yes, markets, very good. Inflation. Inflation will explode. Okay? So maybe Jerome Powell say, hey, let me try to raise the rate a bit. Try to save the situation. Like just now what I mentioned to Ethan, right? There's a possibility, that the Fed might raise a rate a little bit to fight the inflation. Then what will happen is that unemployment rate will die. Okay. Unemployment rate not die. Unemployment will increase so high that people will die. Bank will start to collapse. Because can you imagine? Now the SOFR rate already ignore your rate cut already. You still go and increase rate, the SOFR rate will go through the roof. So what can Jerome Powell do? Is that maybe don't do anything. Then both will happen slowly. That means your inflation will happen. At the same time, you're going to see unemployment, you're going to see no productivity. Then what's going to happen? Stagflation. This is very, very problematic. So yes, I know Trump wants to cut rates. But remember, the Federal Reserve need to balance two things. Inflation, okay, and what? Versus the E word, employment. Okay? So I think right now what they are very scared of, right, is employment. That's why Jerome Powell is saying we are going to cut first. Since inflation, they call it transitionary. Although this word, I think he used before, he used the word transitory or something like that. It has not done very well for them. Okay. So I think very, very likely, and this one maybe I can have a continuation of our bet with Ethan. Okay. Is that I think very likely what Fed can possibly do, okay, is that they are going to still cut one more time or even cut further. Okay, so my thinking is end of year, we're going to have one more cut. And in fact, right now they stopped the QT. They haven't mentioned QE yet. That means they basically say, I'm going to stop withdrawing cash from the plumbing. I have not told you that I will pump more money, more water into the plumbing to restart the plumbing. But I can tell you, with the bank reserve at a very low level, less than 3 trillion, he will have no choice but to do this. Okay? To me, it is high probability event. 80-90% he will do it. Right? Okay? So what's going to happen? What I think is going to happen is that firstly, we can get very bullish on the rate cut, but remember, financial plumbing is even more important. Because if the plumbing fail, the whole system fail. Okay? Then that will really be a Halloween. Okay? That will really be horrendous. Right? So I don't think the Federal Reserve will let this happen. Likely what will happen is that if the plumbing close to fail, the Fed will step in. And because right now they already don't have much assets left, much reserve left, they have no choice but to start some kind of QE. Now, this is getting very technical. QE is not exactly means money pumping, but it could be other things. But basically, improving liquidity in the system. And what is the effect of that? Is that I think we are very likely to see asset prices rise again. Okay? But do take note, in the short term, right now, you can see the market and the funding is very disconnected. The market is right, to the moon. In fact, right now, let's look at current market, right? Where is the market going right now? Okay? Let's look at the market. The market is up, Nasdaq is up 0.8, S&P 500 up 0.4, Bitcoin up 1.5%, gold price still hovering above $4,000. Everything tells you that, hey, it's good, So the market and the funding market now is a bit disconnected. Okay? So expect volatility ahead, right? But to me, volatility is opportunity. Okay, I think volatility is a lot of opportunity ahead. All right. Okay. Any questions before I want to talk about some opportunity that I see in the market right now?